Right now, as we speak, Intel stock is trading live at $43.68, pushing up by approximately 0.47% in today's intraday session. The market is open, the tickers are flashing, and while a fraction of a percentage point might look like a quiet morning on your Fidelity mobile app, do not let that calmness fool you. This stock is sitting at a bubbling cauldron of geopolitical pressure, corporate restructuring, and rumors so loud they are shaking the walls of Wall Street. The expectation for Intel has long been that it is a legacy player, a company that missed the mobile wave, fumbled the AI baton, and got left in the dust by NVIDIA stock and AMD. That is the story everyone knows. That is the story baked into the price for the last 2 years. But the reality? The reality is starting to look drastically different. We are seeing signs that Intel is not just trying to catch up, it is being positioned as the geopolitical failsafe for the entire Western world's technology infrastructure. When you combine that with the sudden electric whispers that they might be manufacturing chips for Apple again, you have a setup that defies the dead money narrative completely. Most people think Intel is fighting for scraps. The deeper analysis suggests they are being fortified to become the only alternative to Taiwan in a precarious world. If this reality holds, the ceiling is much higher than the current charts suggest. Let's talk about what is happening right this second. The stock is hovering near 52-week highs, having broken through the $40 resistance level that acted like a concrete ceiling for months. You might see this on your Robinhood app and think it is just a sympathy rally with the broader tech sector, but the volume tells a different story. Institutional accumulation is happening. The big money is starting to sniff out a turnaround. Yesterday alone, we saw a massive surge of over 8%, and today, rather than giving those gains back as profit-taking, the stock is holding its ground, consolidating, and churning. That is bullish behavior. When a stock spikes on rumors and holds those levels the next day, it tells you that buyers are not just renting the stock for a quick trade, they are buying to hold. It indicates a change in character. For a long time, Intel was the stock you sold on any pop. Now it is becoming the stock you buy on any dip. This shift in psychology is subtle, but it is the difference between a bear market rally and a true trend reversal. We are seeing heavy trading volumes, far above the average, which suggests that funds, perhaps those managing Fidelity Investments or Fidelity Mutual Funds, are reallocating capital back into this name after years of underweighting it. The catalyst driving this current fever pitch is a report that came out suggesting Intel could be on the verge of landing Apple as a Foundry customer. Let's pause and really unpack that, because if you were just skimming headlines on your SoFi trading platform, you might miss the nuance. We are not talking about Intel designing chips for the iPhone. That ship sailed long ago. We are talking about Intel manufacturing Apple's own custom silicon. The rumor, specifically from analyst Ming-Chi Kuo, points to Intel potentially producing lower-end chips for Apple, possibly starting in 2027. On the surface, low-end sounds unexciting, but you have to look deeper. Apple is currently almost entirely dependent on TSMC in Taiwan for its silicon. If anything happens in the Taiwan Strait, a blockade, a natural disaster, a geopolitical flare-up, Apple's supply chain evaporates overnight. Apple needs a backup plan. They need a plan B that is not in a geopolitical hot zone. Intel is that plan B. By securing a foothold with Apple, even for lower-tiered chips, Intel validates its entire Foundry strategy. It proves that their manufacturing process, specifically the upcoming 18A node, is good enough for the most demanding tech company on Earth. This potential partnership is not just about revenue. It's a stamp of approval that could bring other massive customers through the door. It changes the conversation from, can Intel fix their fabs, to how much capacity can Intel sell? While the Apple news is the shiny object grabbing attention on social media and Robinhood crypto forums, The real structural story is the massive investment Intel is pouring into its packaging facilities, specifically the $208 million expansion in Malaysia that was just announced. Most people ignore packaging because it sounds like putting chips in cardboard boxes. It's not. Advanced packaging is the new battleground. As chips get smaller and more complex, the way you stack them and connect them matters more than ever. This is how you get better performance without just shrinking the transistor. By doubling down on Malaysia, Intel is building a global supply chain that is resilient. They're creating a network that can handle the complex 3D stacked chips that AI demands. This is where the comparison to NVIDIA stock becomes relevant again. NVIDIA designs the chips, but they need someone to package them. Intel's bet is that even if they lose the design war, they can win the manufacturing and packaging war. It's a pick and shovel play on the entire AI industry. If you are looking for investment help or trying to figure out how to play AI without chasing stocks trading at 100 times earnings, this manufacturing angle is the hidden gem in the Intel thesis. This brings us to the macroeconomic and political layer, which is arguably the strongest tailwind Intel has. We are living in a time of economic nationalism. The United States government has made it abundantly clear, through the CHIPS Act and direct investments, that it will not allow its domestic semiconductor manufacturing capability to wither away. Intel is the only U.S. company that can manufacture leading-edge logic chips. The government is effectively treating Intel like a defense contractor. We saw reports recently of the administration taking a stake in a startup led by a former Intel CEO, and deeper ties between Washington and Intel's Foundry business are forming every day. This provides a floor for the stock. It's the concept of being too big to fail, but applied to technology. When you are managing your Schwab Intelligent portfolios or looking for a safe harbor in your individual brokerage account, knowing that the U.S. government has a vested strategic interest in the company's success adds a layer of safety that you don't get with other tech stocks. It doesn't mean the stock can't go down, but it means the risk of total collapse is mitigated by national security interests. This is a factor that algorithms and day traders often miss, but long-term macro investors watch like a hawk. Now, let's pivot to the contrarian view because we must remain objective. The expectation is that Intel's turnaround is a straight line up. The reality is that manufacturing is hard, capital-intensive, and prone to delays. The Foundry business, making chips for others, is a service business. Intel is used to being a product company, where they dictate the terms. Shifting the culture to a service mindset, where the customer is always right, is a massive internal hurdle. We have seen them stumble before. If the 18A process node, their next big technological leap, has yield issues or is delayed, this entire narrative falls apart. The stock could easily retest the 20s if they miss a deadline. That is the tension you need to be aware of. You are betting on execution from a company that has struggled to execute for a decade. But the recent data point suggests they're hitting their milestones. The Malaysia expansion is on track, the cost-cutting measures are aggressive, they're slimming down the workforce, spinning off units like Altera, and getting leaner. It feels like a different company than the bloated giant of 5 years ago. Comment below how many shares of Intel stock you currently hold, or if you sold out before this recent rally. I want to know if you are chasing this move or if you've been riding it from the bottom. If you are new to the stock market or looking into online investing for the first time, you might be wondering what exactly Intel does to make money today beyond these future promises. At its core, Intel is still the king of the PC and server processor market. The client computing group is their bread and butter. Every time you buy a laptop with an Intel Inside sticker, they get paid. While the PC market has softened post-pandemic, it's stabilizing. People still need computers. Businesses still need to upgrade fleets. This segment generates the massive cash flow that allows them to build these expensive factories. Then you have the data center and AI group. This is where they have lost ground to AMD, but they still hold a massive market share. The server racks that power the internet are still overwhelmingly Intel-based, even if that grip is loosening. They're trying to claw back share with new Xeon processors that are more efficient. And finally, you have the emerging foundry business, Intel Foundry Services, IFS. This is the startup within the giant. This is the division that will make chips for Apple, Microsoft, Amazon, or whoever else needs them. It is currently a money pit, burning cash to build factories. But the goal is for it to become a massive revenue generator by the end of the decade. When you use investment sites or check your SoFi Invest dashboard, you will see Intel classified as a semiconductor stock, but it really behaves more like an industrial turnaround play. Its